Hi guys, I'm Nicola McKenzie, founder and insurance specialist at Dunham McCarthy. And in today's video, I'll be talking to you about the ins and outs of income protection insurance and why it's so important. So stay tuned. Now, before we get into the detail of today's video, I should let you know that here at Dunham McCarthy, we are a team of insurance specialists. We deal with lots of different insurers, from high street mainstream insurance companies to specialist insurers, to find you the best deal for your circumstances. And best of all, the insurance service that we provide is completely free of charge. So if anything that I discuss in today's video is something that you want to explore and look at options for, we specialise in life insurance, critical illness and income protection, as well as mortgages and many more areas as well. So make sure that you get in touch and book in today for a free of charge appointment. And you can do that by heading over to our website, and I'll put the links on screen and in the description below. Of course, as well, if you enjoy this video, make sure that you subscribe to the channel so that you don't miss any more uploads from me. But now let's get into the detail of today's video. Now, let's start by looking at what income protection is, just a really brief summary to break it down, nice and simple. Now, income protection insurance covers most illnesses and injuries that would stop you working either in the short or the long term. However, the type of income protection insurance that I'm talking about today doesn't include redundancy. So we're talking about accident, illness and injury. Now, income protection is going to be relevant to anyone that simply earns an income, whether you live in rented accommodation, have a mortgage, that doesn't really matter. It's about, would you struggle financially if your income was lost through a illness? Now, it's a very, very common thing to have in place if you're self-employed and those that have very little or no sick pay. But even if you have a sick pay that lasts for, say, 6 months or even 12 months, there are still many illnesses that could see you off work beyond how long your employer will agree to pay you for. So income protection could still be relevant in those scenarios. So the easiest way to think of income protection is it is extended sick pay. It's the same thing as sick pay that your employer would provide. The only difference is that you would choose how much you're covered for along with other options, and it's an insurance company paying you instead of an employer. Now, let's have a look in a bit more detail about how income protection policies work. It's going to replace part of your income if you become ill or injured to the point where you can't work. Now, income protection will usually cover you either until you return to work, until you retire, until you die, or until the end of the benefit period arrives under your specific policy. So what I mean by that is some income protection policies will agree to pay you an income for 12 months, some will agree for 24 months, some will do 5 years, some might even go way up until retirement. The difference between those options will obviously have an impact on the cost of the policy, but ultimately that is when an income protection policy would stop paying out. Now, with most income protection policies, you can claim as many times as you need to. Now, that's obviously going to vary depending on who the insurer is, the terms and conditions of the policy, but in most cases, for as long as you're insured for, you can claim as many times as is necessary. Now, next, let's look at when does income protection pay out. Now, income protection will pay out depending on what is called your deferred period. Now, you choose this on the outset when you take the policy out, and it's going to depend on your sick pay from your employer, what other support and other provisions you have in the event of a sickness. This is going to help you to determine how quickly you might need the policy to pay out. Many insurers as well, if you've got sick pay from your employer for the first 3 months, they're not going to pay out in addition to your sick pay from your employer, because the argument is you wouldn't need an income if you're already getting it from your insurer. So in that scenario, your deferred period would be 3 months. It would kick in at the point where your employer stops paying you. Now, your deferred period can range from anything from some insurers will provide day one cover. So if you're self-employed, you have no sick pay benefits, you have no savings or other provisions, then day one cover might make sense. If you have 12 months worth of sick pay, then 12 months as a deferred period might make sense. And The deferred period is also going to have an impact on the cost of the policy. So the longer the deferred period is, the cheaper generally that the cover is going to be as well. And then you have deferred periods, everything in between. Day one cover to some insurers that will defer for up to 24 months. You can get a 4-week deferred period, 8, 13 weeks, 26 weeks, and so on and so forth. Now, another key point to mention here of when does the policy pay out? Well, that's largely dependent on the quality of the policy that you take out. And again, guys, that's why you need specialist advice when you're looking at this sort of thing, to make sure that you don't get caught out thinking that a policy is great just because it's cheap. And like most things in life, cheap doesn't always equal best. So make sure that you get in touch and we can help you look at the options. But ultimately, to give you a brief summary, there are different definitions that insurers will use when providing income protection, and this will have a significant impact on when the cover pays out. Now, there are typically 3 main definitions that insurers go by, and I'm going to take a minute just to explain each 3 of those definitions. Now, some insurers will pay out using what's called an own occupation definition. What that means is that the cover will pay out for any reason that you cannot do your own job. It's the most relaxed definition, and that would offer the highest level of protection under an income protection policy, because it could cover anything from a mental illness to a physical injury to cancer, okay? Now, the next definition that some insurers will go by is something called suited occupation. Now, if an income protection policy is bought on a suited occupation basis, this means that your insurer accepts that you can't do your job anymore, but they may not pay out when you make a claim if the insurer believes that you could do something very similar to which you are suited. So let me give you an example. Let's say that you are a field sales rep and you travel out to see clients, and you have a broken leg. So that's going to see you off for the next 8 to 12 weeks. So that means you can't drive. That would impact the ability to do your job. But let's say that you could do sales, but from an office space. So you can now see your clients remotely using the phone or over video calls. In that case, if you had a suited occupation definition, then the insurer would not pay out, because you can still do your job, but just a slightly different job, but your level of experience and qualifications are still matched to that other job. Now, activities of daily living is the 3rd definition that I'm going to explain that some insurers would use, and this offers the lowest level of protection. It's only going to pay out for physical illnesses, as the insurer is going to test that you cannot complete usually 3 out of 6 tasks. Now, these tasks are going to vary depending on who the insurer is. They all have their own benchmarks, but they'll include things like getting dressed, climbing up a flight of stairs, walking more than 200 meters. This type of cover is going to be the most difficult to claim against, as you can imagine, because the insurer might say, we will only pay out if you cannot complete 2 or 3 out of these 6 tasks. So how much will the policy pay out? Now, the amount of cover that the policy pays out is all going to depend on your earnings in most cases. Income protection pays out a percentage of your income, usually between 50 and 70% of your income, but that's usually your pre-tax income, okay? And most payments are free of income tax. So 50 to 70% may not sound like a lot, but bear in mind that your salary is taxed. The insurance company are not going to tax the income protection. So you would usually find, if you're going for the maximum benefit amount, that it's going to be close to your net after tax salary. Now, you can of course choose to be covered for less than that 50 to 70% benchmark. Some people might just choose to cover their mortgage or rent payments, mortgage and rent payments plus bills. It really just depends on your budget and your circumstances as to how much cover you decide to have in place. So how much does income protection cost? Now, like most insurance policies, the premium is going to be based on very many different factors. It will include things like how old you are, your health, whether or not you smoke, the amount of cover you're taking out, the term of the cover, the deferred period. So just to recap, deferred period, how long you're waiting until that policy kicks in and starts paying you. So day one cover is going to be considerably more expensive than if you had sick pay and other benefits to mean that you're able to wait 12 months before the policy pays out. What type of job you do is also going to have an impact on the cost of the policy, and also the benefit period. So the benefit period, again, just expanding on an earlier point that I mentioned, some policies will offer the option to receive the benefit for 12 months, some will pay out for 24 months, some will pay out until your intended retirement age. So if you chose to have a policy that pays out until your intended retirement age, if you could never work again, that's going to be considerably more expensive than an option that only pays you for 12 months. Now, a few other points to consider, guys. Income protection is not a replacement for critical illness cover. I often get asked the question, why would I have income protection and also consider critical illness? Now, what you need to understand is that income protection, I would explain it as complementing critical illness rather than replacing it. Again, this is going to depend on your individual circumstances as to how relevant it is to consider both of those types of policies. For those that don't know what critical illness cover is, very briefly, it's going to pay out a lump sum of money if you have a critical illness, things like cancer, stroke, heart attack, and many more depending on the insurer. Now, most people confuse income protection insurance with PPI, and they are completely different products. So I'm just going to take a moment to explain the differences between the two. PPI stands for Payment Protection Insurance. Income protection is going to protect your income. PPI is going to protect a specific loan or a debt. So for example, if you were off work sick and you have a credit card and you had PPI on that credit card, all PPI is going to do is mean that your payments for that particular credit card are covered, but you would still have to find money to pay your mortgage, put food on the table and cover your other bills. So it's nowhere near as advantageous as an income protection policy would be. Income protection, on the other hand, is going to pay you a monthly income that's going to be a percentage of your salary. And the money that gets paid to you, you can spend that money on whatever you see fit. It's not specific to one individual loan or creditor. So in summary, guys, income protection can provide so much peace of mind. It can protect your lifestyle, protect your income, and pay the bills, help you to avoid financial mess in the event of losing your income. And think of it this way, for most of us, if without our income, we're really going to struggle to do most other basic things in life. So if you're happy to insure your mobile phone, your washing machine and any other material items, to dismiss insuring your income could be a costly mistake. So it's definitely something to consider for most people. And of course, make sure that you get in touch and book in for a free of charge appointment. We can look at your situation and circumstances and pick out the most suitable options, the most comprehensive options within your budget. Like I said, we look at high street and specialist insurers to find the best option for you. And with any insurance policies we arrange, we also provide a free will writing service via mylastwill.co.uk. So book for a free appointment today, and of course make sure that you subscribe to this channel if that video has been useful, so that you don't miss any more videos from me. But that's everything for today, and I'll see you in my next video.